Hello and welcome to the Financial Wellness Hour. I am your host, Hirsch Sherman, and I'm really thrilled to have you here today with us on WGSN-DB, the Going Solo Network. This show is for those who want to learn more about financial wellness and how to create it. And we're going to look at different life cycles, and we're going to explore them both emotionally and financially, which sounds a little weird, but that's because personal finances, believe it or not, are actually more about the emotions associated with your finances than the money itself. We're going to have fairly general discussions, but we would love to make it more relevant for you and more personal. So please do call in. You can reach me through my website at lifecycle.financial. That's lifecycle.financial. Or you can post your comments and questions on Facebook, on YouTube, or anywhere else that you might be listening to this radio show. Over the last several years, the mortgage industry has had enormous changes in the way that it works. The process, qualifying for a mortgage, forbearance, that's been in the news for the last probably 18 months. There's just so much going on in the industry. And this is usually the largest debt that somebody will take on in their lives, as well as the largest asset that they're going to invest in. It needs to have the appropriate consideration and understanding for everything that's going on. And you need to be on top of it because there is a lot that needs to get submitted and done when it comes to the underwriting. We've got historically low interest rates. I think everybody knows that at this point. Everybody also knows there's a global pandemic going on. And not everything is happening in person, which is also different from what historically we've seen. I'm very happy to have Doug Katz join us to wade through the turbulent waters of the mortgage process and also how this can impact somebody who is going through a divorce. I think that is huge. Doug, welcome. I'm excited to have you here. Thanks for joining.
Thank you so much. Glad to be here. I really, really appreciate you having me on.
No, it's great. And I think this is such a big topic. I think especially in general, people are not always familiar with it. You don't buy a house every other year. But as well, when you're going through a divorce, there definitely are nuances, which we'll cover as we go through things. I'm going to also, just so people understand a little bit of your background, talk about your background, talk about why you got into the mortgage lending business, if you would.
Sure. Well, I've been in the mortgage business since about 2001, so almost 20 years, maybe a little over at this point. And, for good, bad, or different, I got into it for financial reasons. I was in the technology industry before that, the telecom industry specifically. The bottom dropped out of it and was kind of looking for my next step. And getting in 2001 was the crazy, it was the boom like we're seeing now. And it looked like a great place to make money. I got a military background. I knew a lot of military guys who had gone into it and taken the lessons that they learned within the military for, organization and things like that. And we're doing real well. But as I got into it, I really connected with what you said, the importance to someone's financial picture and the degree of, the other part of the military is taking care of people and how a good mortgage banker can really, or broker, I'm actually a broker now, can really make the difference for somebody, not only for that one experience, but in the broader sense of ending up in the right product. Like anyone can deliver a mortgage. There's call centers that do it right now. It's a different story to integrate it into their broader picture and have them in a good position when they get out. And, in the last 20 years, I've done everything from manage, large sales teams, to originate myself. And actually, most recently, I came to where I'm at right now, on time mortgage. That's where I do my origination in the residential space, because I really wanted to be back where the rubber meets the road and help people. And that's been very as I look ahead to however many years I still have in the industry, a great place to be to do that.
So I'm actually glad you brought up that you started in 2001, and it's important just to kind of cover the last 20 years in some ways. Somebody can say to you, "Oh, I've been in the mortgage industry 10 years." That sounds like a long time, but there's really not that much that's happened in the last 10 years as the prior 10 years. If you look at it, as you said, 2001, it was unbelievable. You didn't even need a market. People were calling you kind of thing. Just a few years later, 2007, 2008, 2009, there was a horrendous drop in the market. It impacted not just residential, but it impacted industries because when people were moving around the world, they had to sell a home. People couldn't get to the closing table because they didn't have enough money because of what had happened with the drops. We've seen recoveries. We've seen the cycles come through in a very different way. We've seen also, obviously, based on some of the things happening in 08, 09, how it molded those next several years of regulations. And at one point, I think there was a regulation being drawn every other week. So being able to stay on top of these kind of things, it's incredibly important because, you know, I mentioned it kind of in the intro that things have changed a lot, but just because you've been in for 10 years, haven't really seen the full picture of what the mortgage industry is in the highs and the lows. And I think that's something that's very important when you're looking for a specialist, to see somebody who has been through both, who can really bring that to you.
Well, and one important thing to highlight on that just shortly is the real big thing that changed in a lot of ways is compensation for the mortgage, the originator. Up until about 08, originators had the ability to price kind of, you know, I kind of compare it to a plumber, right? A plumber is going to walk into a house and he's going to look at a project and say, here's how much a project's going to cost. And then go to his next project and go, this is a harder or easier project with more or less involved and may charge more or less. After 08, the fair lending rules and a lot of the other regulations meant that mortgage bankers and mortgage brokers could no longer charge disparately, not only per individual, but on the difficulty of the program. And what you saw was a pretty large exodus of people who were in the industry to, you know, the people who were out to screw their clients, and there were a lot of them. Maybe not a lot. There were enough of them to give the industry a bad name. Those individuals would charge more. They would take premium and pocket it, and that was a bad thing. If you've ever seen the movie The Big Short or read that book, there's a lot in there about that. It's a great reflection of that. But when it changed, I think guys like me and some of the other hardcore veterans of the industry were really in it for the right reason, to help people. You know, you have to do more loans now to make money. You have to do more to keep the clients happy. But, you know, there isn't that big win where there were people charging 3 and 4 points on a deal and pocketing a lot of it. And that's changed a lot. So, you know, you do have a segment of the industry that is post 2008 and didn't even know what that world was like. But a lot of the companies then have gone to the least common denominator for delivery because they, you know, there's less ability to kind of manage that compensation. Where now, you know, guys like me who've been in this for 2 decades are in it because they really want to help the clients. And I think that's a good question that people who are getting a mortgage should ask is, how long have you been doing it? And things like that. They really need to get to know their mortgage banker or broker, and they really have to be comfortable with that and understand whether that person fits their criteria.
Yeah, I think that's very well put. And, you know, everybody working for you should be making money, but they don't have to be getting rich of you specifically, which is also important.
Exactly.
You know, before we focus on kind of getting a mortgage during or after the divorce, which is the crux of our discussion, I wanted to cover a few different things so people really kind of get a larger feel of the mortgage industry in general. And we can obviously bring it all to what's relevant for today, as well as if you're going through a life transition. In the past, people would look at things like fixed rate versus variable rate mortgages. You know, I remember my very first mortgage, I was thrilled. I got 6%. I was like, yes. I remember when I used to actually audit, I'm going back 22, 23 years now. I used to audit mortgage banks. The average was probably in the 8% range. So when you're looking at sub 3 and sometimes even depending how you do it, you know, lower than that, we are really talking about incredibly low historical lows. You know, I remember when I moved to America in 1987, I was at a lunch and somebody said to me, I've got a mortgage that's under 5%. You will never see that, he said to me.
Yeah.
So can you give a quick explanation on kind of the difference, I guess, and also share a little bit on your thoughts with interest being so incredibly low right now? Does a variable mortgage even make sense for somebody?
Yeah, I mean, the difference, you know, I think people get spooked by the word variable. I think with a variable mortgage, you have to think that's a short-term fixed, right? Whatever that teaser, and they call it a teaser term in the beginning. I don't know whether I like that either. You know, it's a tool like anything else. So the times that in my entire career that I've used variable rate mortgages were were a couple of big ones. One, when something's driven by the life cycle, right? If somebody is buying a property, you know they're not going to be in it for a long enough time to matter, or to look at a fixed rate. A variable rate might make sense because they're never going to get that advantage because they're not in it long enough to get the advantage of the fixed rate mortgage. The other time is a lot of my high net worth clients would go with variable rate mortgages because they were using financing as a tool for their larger financial picture, and they really didn't care. They could pay off their mortgage tomorrow, so they were looking for the lowest rate. They would pay interest. Most of them wanted interest only when we could still provide that. There's some of those out there, but not as much, because they were just using it to balance their income. What I really did not like using it for was to push somebody's affordability, right? If somebody's like, hey, I get a lower rate, and so I can buy more. Now, the market's changed a little bit, and now most variable rate mortgage approval processes take into account a fully indexed rate, meaning past the teaser rate, when that loan could adjust, what is kind of that worst case adjustment on the first adjustment, which is how it should always have been done. It should be a money saving tool. It should be something that marries up with your whole financial picture, and it shouldn't be something that allows you to afford something that you otherwise would not be able to. Right now, we're not doing a lot because there's just not enough spread between the two to make it worthwhile. And when you're borrowing money under inflation, like if you're borrowing money at near 3 or under 3, I mean, we're doing VA loans in the low 2s. I would most of the time talk people out of a variable rate mortgage because you just don't know what's going to happen. COVID and a lot of other stuff taught us, hey, you might plan on moving in 5 years, but if you don't, what happens? And there's also more people than ever who are turning primaries into rental properties later on. The growth of the short-term rental Airbnb world means a lot of people are like, oh, you know what? I didn't want to be a landlord, but now I'm going to. And being in a fixed rate mortgage on a residential owner-occupied property is way less expensive than an investment property. So many are taking advantage of that.
And I think, you know, what you said, it sounds almost, some people might look at it, I should say, as it's unfair. Wait, my mortgage rate is this on the variable, but why are you looking at 3 years or 5 years down the road? But that really is protecting the buyer.
Yes.
You know, you don't want to be in a home and 3 years the mortgage goes up 2%, or you know, and then all of a sudden you can't afford the payment because you overbought. So I think that's a good thing, actually, that they've changed to doing that, and helpful for
a lot of people silo, right? So, you know, it's the same discussion sometimes with 15 and 30 year. And I have people say, I want to get a 15-year and I want to pay it down early, which is fine. But if somebody's really in tune with their financial picture, a lot of times the 30 makes more sense, because if you're borrowing under 3%, you know, I tell people if I could borrow under 3% and have a 100-year mortgage and never pay it off, I would gladly do it, because the equity in your home is stranded equity often when you're paying it off. And I can't tell you how many times people did a 15 and then they're like, I want to do a cash out refinance. Well, now they're doing a cash out refinance. They're at market rate. You know, instead of taking the money they would have to pay their house down early, work with their financial advisor or their financial planner and put that money somewhere where it's growing, and then then they're able to use it later. So it's definitely a deeper conversation than just what's the product. It's what's the product and the impact on you.
And I would also add to that, you know, just or build on that, maybe is a better way to put this. You know, I'm picking numbers here. You get a mortgage at 2.75%. Let's say you get to deduct that very often, so you're paying actually equivalent to less. If you're working with a good money manager, wealth advisor, whatever you're working with, I mean, that over the long run is a very easy target that they should be able to hit. So your upside in working in a 30-year and investing the additional money actually is much greater, I think, in many ways, than trying to just throw it into your home.
I can't remember who told me this, but at one point I was talking to somebody, high net worth, and they were like, freedom isn't paying off your mortgage necessarily. It's the ability to pay off your mortgage tomorrow if you wanted to. So it's like the argument to say putting the money in the market, having a diversified approach, and integrating your home into that whole approach. That's the right way to do it, instead of saying, you know, I hate debt. Well, debt and leverage are two different things, and over leveraging and having bad debt is one thing. But, you know, I think most people would agree that having a mortgage, if it's okay in your cash flow and all that, isn't necessarily the worst thing if it's a multiplier on other things that your financial advisor may be doing for you.
Right. And as we've said more than once now, it's a piece of a larger picture. Absolutely. And on the divorce side, and we'll still get to the divorce side, obviously, but on the divorce side alone, I've had the very first client I ever had actually emailed me, hey, I'd like to talk to you about when is the best time to sell the home. And I responded, I don't know. I need a larger conversation, because, you know, whether buying the home, selling the home is the right thing, you know, we don't always know. And it ended up, she actually bought her husband out because they had less than 30 months left. They had just started their divorce. By the time they were done with the divorce, it was about 14 months left on the mortgage, and she was going to go from about about $2,800 down to about $1,500 in her monthly payment. She couldn't find anything remotely close,
right,
for $1,400, $1,500, you know, in the place she was living. So it's a larger strategy that comes in, really.
Absolutely.
But talking about closing or selling, we've obviously heard horror stories sometimes about holdups at the closing table. What are some of the, I guess, if you can share a couple of the biggest reasons that a mortgage closing is delayed, and maybe give one or two from the buyer side, one or two from the seller side, so people are really aware of some of the things.
Yeah, I mean, most of what I see is kind of from the buyer side. I mean, the seller side, I'll start with the seller side because it's less of an issue. And most of the time with that, it's driven by maybe title issues of which they weren't aware. Maybe there's a lien on title. Maybe there was a mortgage refinance that they did and it didn't, you know, another loan wasn't cleared. So you've got to clear title things. If there's stuff that has to be done on the property, I mean, you're not seeing as much of it now, but if there were repairs, if you're doing FHA or VA, sometimes there's repairs that need to be done. And right now, sometimes it's not even their fault, right? Like I just moved recently. We had to do some work on the property. It took me from May until beginning of September, more or less, to find contractors to do small work, like redecking my deck and doing some crown molding. If you're trying to do a big project right now, you can't find anybody to do it. Lumber and stuff has come down, but it's really expensive, and they're going to the big projects.
Yeah.
So things like that can really delay it. On both sides, before I transition over to the buyer side, any type of procrastination on either side. When I start the process with one of my buyers, or even on a refinance, I say, we're a team. I said, I'm providing this to you, but I'm kind of your Sherpa. Like if I ask for a document, one, I need it. I'm not asking because I feel that like I'm going to make your life difficult. It's more a matter of saying it's something that we need. And I say, this will go as well as you cooperate and help, and getting back to me quickly, getting back to me completely is the best way to do things. Small things can really, really deep six a timeline. You know, if there's a document that you need and it takes a while to get it, or if it's not complete, the mistake people make, this is both buyer and seller, is like, okay, when I turn in that document, of course, the underwriter is waiting for this document and they're, thank God that you sent it. And then 10 minutes later, they're underwriting it. Right now, with the amount of loans going through the system, it's not unheard of to have 24 to 72 hours turn time for somebody to look at it, to include clearing conditions. So what I always do is I sit down with the client, more with the buyer than the seller, and I say, okay, let's look at a calendar. And they're like, okay, I have 30 days to close. And I say, well, okay, now look at that 30 days. Take off all the weekends because, you know, most of the underwriters say, okay, so now you've got 20 days. And, you know, then you go through all this and you say, look, any delays are going to cause issues, and you're part of that. Appraisals are causing some challenges right now, and it's not necessarily the appraiser's fault. It's just they're so busy. So a lot of it, the biggest delays are self-inflicted, I think, from both sides. Now, I will say, I talk to a lot of clients who, you know, the internet is a great thing and a horrible thing. And a lot of people gravitate toward low interest rates. Oh, this guy's giving me a low interest rate.
Right.
But the mortgage industry is a very, very efficient market. Rates are generally the same everywhere. And the only way that you're able to provide a lower rate is by having a model under which you can maintain a certain profitability. So what you tend to see with the lowest interest rates would typically be, and I'm not saying it's a generality, but it's not 100%, but a lot of the time it's somewhere in service, right? As I said before, you've got younger people who've moved into this industry who might be inexperienced. I remember once before I came to the company I'm at now, I was getting a refinance because I didn't want to do it through the company I was at for you know, personal reasons. And I was talking to somebody who had been alive less time than I've been in the industry. Those people are getting paid less, right? Their splits are less, the commission's less, they're at call centers. They have less experience. And I think that's another huge mistake that people make is, oh, a mortgage is a mortgage is a mortgage. And they go to a call center and they find out really, really quickly that they got what they paid for, and mistakes along the way with that lender then create challenges.
So I just want to add something there with the documents. There is a lot of paperwork sometimes that has to be, it might be electronic, I get that, but you know, somebody going through a divorce in an emotional state with a lot of other things hitting them, not always the most organized situation for somebody. They may not be at their best when it comes to being organized.
The huge one right now, before you go to commercial, is self-employed. If you're self-employed, it's always been difficult. Right now, expect a very, very document-heavy process.
Yeah, I've heard that too. I've heard that too. And I'm glad that you brought that up because I was trying to find a good spot. So, Doug, I'm going to ask if you can share, how can people easily get in touch with you? And then we're going to go to a commercial break.
Well, the information down below that's my divorce practice. I also do mediation as it applies to the property. So a lot of people these days are going pro se divorce, but they really should talk to somebody who understands the divorce world, and we're going to talk about it. So they can get hold of me that way. I know one of the commercials coming up, it's got my information as well for the mortgage company that I work at, and they can reach me there. All roads lead to me. So if they call me this way and they're just looking to get a loan, they'll be able to reach me that way as well.
Great. And we will be right back. Thank you. Hello, welcome back. We are on WGSN-DB, the Going Solo Network. We have Doug Katz with us talking about divorce, mortgages, and you. And we've covered a lot. One of the things I like to do is always recap some of the things. I never get them all, but some of the things that we've discussed, and I know I'm not going to get them all because we have covered a tremendous amount, but we spoke about basically, there are a lot of different mortgages there, whether you're looking at the interest rate, whether you're looking at the duration, whether you're looking at the way it is set up for you, and making sure there is definitely not a one-size-fits-all. So how do I find the right one for me? Because this is a very big investment, as well as often a lot of debt, and possibly the most debt you will take on in your life. We also spoke about reasons that closings are delayed, your personal situation playing significantly. We will definitely cover that a lot more as we go forward, because understanding how going through a divorce and how that can impact you, even just from refinancing, is very, very important. But I think one of the big things that came up right at the end that is worth stressing is you are not looked at as the same as your neighbor necessarily when it comes to getting a mortgage. If you are self-employed, if you are getting back into the workforce, if you have had a job for 20 years, all of these might be a different view from the mortgage banking perspective on who you are and what they want to provide. Because remember, when they look at you, although the right professional will get to know you, really they are summing up the risk that they are taking on by giving you this money. They are in the lending business. They are not in owning real estate business in most situations. So those are some of the things just to think about from their perspective as well. Doug, I'm going to jump right into a couple questions. I'm going to probably add a couple together, but we've heard a lot about, more so 18 months ago. I was kind of surprised about 6 months ago it came back into the news. Didn't have quite the same spread or the same exposure. We spoke about, or heard about, should I say, forbearance. A lot of people were panicked, losing jobs. COVID was hitting. Can you talk a little bit about forbearance and maybe some of the pitfalls that come with that? Because it sounds great. Oh, don't pay your mortgage for 6 months. But as we know, there's no such thing as a free lunch, right? So
absolutely. Forbearance was, it's a tool. And what's interesting, it popped on the scene, but forbearance had been around for a long time. I had past clients and friends who had issues, and they're like, what can I do? Can I refinance? I'm like, well, forbearance might be a better option for you right now. And it exploded onto the scene with COVID. And it was a decent thing for a lot of people, right? And for those who are unfamiliar with the term, it basically is a cessation of your payments for a certain amount of time with no adverse impact upon your credit or that mortgage. And then it's basically kind of kept aside, right? The mortgage, the interest and principal that you owe is sort of put off to the side. And at the end of the forbearance period, it's determined how are you going to pay it back? Like, how is that going to get back on track? And a lot of people took it. I think there were some recent articles that said, about 1.7 million people or something like that took it. And there's a lot still out there. There really are no pitfalls. Like, what it comes down to is, and here's the challenge, is it exploded so big onto the market that there is very little consistency from institution to institution on how you exit forbearance. So the challenge becomes many people didn't do the research up front. And I did some writing about it in the past. I said, make sure you look at your documents, understand the agreement that you signed, and understand what's going to happen at the end. And a lot of people didn't do that. And that was a challenge for them. But basically, knowing what the requirements are to get back on track. I think everybody assumed, hey, my mortgage company is just going to throw it on the back and I'll be good to go. Wasn't necessarily the case. VA might be different than conventional. So at this point, if anybody is in forbearance or emerging from it, they really have to get on the horn with their provider and say, what does all this really, really mean to me? Generally what you're seeing, and I don't want to say this is for every institution, but generally what you're seeing is you'll come out of forbearance. There'll be a period of time where they give you sort of a test, right? Can you cover what the new payment scheme would be? Sometimes it's a lower interest rate. Sometimes it's not. But what they're doing a lot of times is they're adding it to the end, increasing the size of the mortgage, keeping it the same interest rate or lower, and then that determines what the new payment is. So maybe instead of a 30-year mortgage, you got a 32-year mortgage at whatever that rate was or lower. And they put you in this 3-month test period, and you pay then, and then that's what you have going forward. Most of the time, you've got to make it through that 3-month test period. And again, I'm generalizing, it could be different with others. Mileage may vary. And then you have to make between 3 and 6 payments after to be fully emerged from forbearance. Where it's a problem is not buying a new home, but on a refinance. If you haven't done all that, then you're likely going to be declined because you don't meet those minimum requirements.
So I'm glad you brought that up. And both of the points I'm probably going to say, just because they're worth repeating. Number one is, how do you get back into the swing of your mortgage? It's not necessarily, oh, I had 6 months, I didn't pay their tax 6 months on the end. You may, depending on your mortgage or forbearance, should I say, you may have to pay it all back just to get into the swing of things again.
Yes.
Well, just as an example, if you're struggling with $1,000 a month, 6 months later, when you've got to give them $6,000, that could be issued. The other one is if you are going through a divorce, and as you said, you have this test period, you may not be able to refinance, and that becomes an issue. I read through a tremendous amount of divorce decrees. MSAs is often called. Those marriage settlement agreements often will say you have to refinance in 60 days, in 90 days. And if you've had forbearance, sometimes it literally is impossible to refinance within that time frame because of this period that you've just heard about. And so it might take you 6 months to really be able to refinance that mortgage. You can put in there, I will start the process within 90 days, but you cannot always guarantee, especially with a forbearance, you cannot guarantee that it's going to be closed. And so these are some of what I would say are the unforeseen pitfalls when it comes to a divorce.
Well, and I think the big thing is be a participant, not a spectator.
Absolutely.
So if you took forbearance, and it was very easy to take, and again, it wasn't necessarily wrong. I know some people who took it preemptively, right? Some self-employed people said, I'm going to go into this to keep my reserves up so that it doesn't become a problem. And that's legit. Like I look and I say, that's not a big issue. The problem is then people are like, okay, what do I do next? And you've got to manage that process, communicate with your servicer, and figure out what's going on.
Right. And again, that comes to when you're getting a mortgage, you need to understand what you're getting into. When you're getting into forbearance or taking forbearance, you need to understand what you're getting into. Without a doubt, these are things, you know, that most people research a car before they buy a car, right? Yeah. It's the same idea. You're making a financial commitment of some kind. You need to understand what you're doing. So I'm going to ask you, what are other considerations that are important? You know, we've spoken about 15-year versus 30 interest rates, points. Yeah. What are some of the other important considerations when you're evaluating the right kind of mortgage for yourself?
For me, it's really about not siloing. Like I said before, it's really looking and saying, where am I at in my life cycle? Am I going to need money in the future? I have a lot of people come to me about a 15-year as an example. You mentioned that. And I say, well, you know, why do you want a 15-year? And they say, I want to pay stuff down ahead of time and all that. And I said, well, you can do that with a 30. But if you hit hard times, and I said, think about COVID. Your cash flow is your cash flow. And you will not be able to manage that any differently if you lose your job or your hours go down or any of that. So I say, listen, in a 15-year, you can't decide you want to pay a 30-year rate or payment, but in a 30-year, you could decide you want to kind of turn it to a 15, which isn't the worst thing ever. So right. I tell people, like, look at where you're going to be. Don't look at where you're just going to be right now. Look at where you're going to be in the future. Figure out, you know, are you going to have a need for cash flow? Are you going to be doing improvements? What is going on in your life that should influence your decision on how you finance that property? And based on that, lean on your mortgage banker. This is why when I say, or your broker, this is where choosing one is important. If you're calling an 800 number and it's someone who's been doing this for 5 years, they may not even have the life experience to say, oh, you know what? Have you thought about this?
Right.
So I think every consideration is important. And I tell my clients, don't worry about that. I'll bring the considerations. I'll help you understand it. Just tell me what you are looking to do and be totally honest. The big mistake people make sometimes is they don't share things that they think are either mundane and not important, or that may affect their ability to get a deal done. And a lot of times that can put them in the wrong program.
And, you know, just emphasizing an example there, because I actually just ran into this yesterday with a discussion with a client. They were asking me, should they get a 15-year or a 30-year? And I said to them, well, let's look at your time horizon. And they spoke about the next 2 or 3 years. I don't remember exactly how much. And I said, no. Let's look beyond. You're taking out a 15-year mortgage. Let's look at the next 15 years, what's coming up. Yep. Well, 10 years from now, their first kid was going to college. 1 year later, the next one, and 2 or 3 years later, the next one. All right at that 15-year mark, they are going to be writing college, graduating college. Well, what about that extra $300 or $400 a month if you put that towards college? Yep. And for the next 10 years, 11 years, you were able to save towards college. Mm-hmm. How does that change your perspective of wanting a 30-year versus a 15? So I love that you work with people in that way, because one of the things, whether they're going through a divorce or whatever it is, I'm always helping people look beyond the current situation that they're in.
Right. And I know one of the things you asked about was points. The interesting thing is people always think points, but if you think of how loans are priced, and I said back in the day, there were nefarious characters who would pocket what was called premium, which is the opposite of points. Nowadays, you can't do that. So if you were thinking of points, I say think of points in premium. So you've got a rate that's typically you maybe aren't paying any points for. It's called par. Basically, when people say, I want something with no points, that's what they mean. But then most of the time, there's some rates that are lower and some rates that are higher. If you take a higher rate, you get premium. I use that often when a client either doesn't want to pay closing costs on a refinance, or if they're on a purchase and they're short of assets, they can take a little bit of a higher rate, and the premium that goes back to them then can be used to pay closing costs and things like that. Points right now, I'm not doing a ton of unless it's a really tight situation where somebody has access to assets to pay points down and to get the debt to income ratio to work, to have them be able to afford it, they're paying points. Generally, it doesn't make sense. And what I tell people also as they're looking at these considerations, people get, and I have this term that I call rate myopia. And they're like, oh, I got to get an eighth lower. And I'm like, well, an eighth lower is $4. And then they're like, oh, it really doesn't matter. And that's when understanding this and having someone who can explain it is important, because everybody gets so hung up on the rate that they freak out if rates move or anything like that. And they don't really know what the impact of that rate is. So what I tell everyone is keep an open mind and be communicative, and you end up in a much better situation overall.
So I'll tell you, one of the big questions I was going to ask you or put out there is, in general, when we're dealing with an area we're not familiar with, we're going to ask an expert. We're going to go to that specialist. I was going to ask you to talk. I don't even need to cover that, but I will say, bringing it back to the divorce situation, there are so many things going on. There's so many decisions that you're making. Studies will show that when you're emotional and stressed, you don't digest things in the way that you do when you're calm and relaxed and you don't have the pressures on you. And that's where having an objective view and that expert view can really come in. If you talk through and you work with the right person, like Doug's talking about, looking at your time horizon, looking at the larger picture, understanding what does that little 0.1% do for your whole mortgage, really understanding they can guide you in a way that a call center, as an example, or applying online is never going to do for you. And that alone may be worth the reason to go to an expert alone, let alone the fact that, as we've been hearing, there are differences from the duration, and doesn't make sense to go with a 15, a 20, a 30. There's so many considerations that somebody can walk you through. Doug does that. He educates you as you're going, which I think is a big thing as well. And that's a big piece, I think, from working with an expert in general. And I think it's just so important. And that leads me straight into, I guess, what are some of the bigger mistakes that you see people make when it comes to this? And I'm sure you've covered a lot. I don't know if there's a couple that you can add on to this as well. And I would add, are there ways to kind of reverse that, or maybe correct some of the mistakes that happen?
Yeah, I mean, I think the biggest mistakes are just thinking that the industry is as commoditized as it is, and thinking, hey, if I go to anybody, if I go to the 3 different lenders, it's all the same thing, and a lot of times that has impact. And the hard part is, it's not like going to buy a car or going to buy something that you might do with a greater frequency. Until you've had a bad experience, you don't know what the impact of that bad experience can be. So as a result, you may not put as much sway in being able to do it. But the company I'm at right now, I think we save more deals than any company that I've ever been at. And people call and they're like, oh, I want this other thing. And, it's been a terrible experience. They're not calling back. They're not doing any of that. The people made the mistake of going, well, I saw a commercial or I saw a great rate in the paper when I called, and really not planning. And I know we're going to talk about divorce later, but really not planning and not understanding that this is an important process and there's a lot of considerations, and that the uniqueness of you as an individual is projected upon and sometimes amplified within the mortgage process. And your situation, if it's complex in general for you, it will be that much more complex in the lending industry. And before we go on to that, one thing I want to say is, there have always been with fair lending, like the lending industry's got sort of a sordid past if you go way back, like redlining and a bunch of things that institutions and lenders did that were bad. I used the term nefarious before, and it's a history that we're getting over as an industry, but it's an industry that is held with some suspicion, and as a result, I think that people need to understand that the things that have been done to rectify that are something called fair lending. And it basically means that guidelines across the industry are applied equitably across the entire industry of all borrowers. They're all evaluated objectively to make sure that no protected class is treated differently, that they receive disparate treatment or disparate outcomes. And that's a big way of saying everybody takes their shoes off at the airport, and the same kind of thing happens in lending, right? It doesn't matter who you are, you're treated the same. So the challenge becomes, I can't tell you how many times, especially now during COVID, people say, but my situation's different. They should be looking at me subjectively. And I'm like, I get it. However, that's not how it's done. So what happens, people think that they're going to get some special dispensation when they enter this process, and they're not going to be.
Right.
And that's a real hard pill for some people to swallow if they've got great credit and certain things, but they can't provide one document that would generally deep six a loan.
No, I think that's an important point. People need to understand that the industry is not going to conform to you. You need to conform to the industry, right?
Yeah. And one other interesting component of that, because I've gotten in huge debates with some of my realtor friends, is the converse of that is if a client comes to me with a request for a particular product for which they qualify for it, but might not be the right product for them, I have to provide. Fair lending says if they qualify for it, I have to give that to them. Right. So the other side of that is people can make bad decisions if not coached the right way to really fit what their situation is. They could look and go, oh, this is the right mortgage for me. And that's a lot of that is what drove 2008. I mean, they vilified the lending industry, but I can't tell you how many times back in leading up to 08, I would tell a client, hey, an interest-only negative amortization loan is a really bad thing for you. And they'd say, well, I want it. And I'm like, okay, I got to give it to you because you qualify for that.
Right. So we have about 4 minutes left. I'm going to ask you to cover about 2 minutes when somebody's going through a divorce. We've covered a lot through, but let's focus specifically now, not just tack it on. What are some of the considerations people going through a divorce really need to think about?
They need to understand that on the dovetail, like on the tails of what I was talking about with specific guidelines that cannot be, they're immutable in some ways. Those don't change because you're in divorce. There are a couple of things in the industry specifically designed for people getting a divorce. You know, if you're buying out your spouse, it may not be a cash out. So there's some really good things. But generally, a lot of those guidelines, even if they're applicable to divorce, are applied objectively. So the biggest mistake divorcing couples make is they say, I've gotten a mortgage before. It's just like every other mortgage. And they apply for a mortgage and they find out that things like child support and alimony, you need a 6-month history.
Right.
Now, there are ways to build a 6-month history before the divorce is final.
Correct.
But you need a 6-month history. You need to show that certain things will continue 3 years into the future when it comes to income. So the challenge becomes they don't plan, they apply. They're trying to meet the marriage settlement agreement that Hirsch, you were talking about earlier on. And then they find out, oh my God, my planning horizon is actually way longer than I thought it was. So what's really important is immediately when you know that you're getting divorced and there's a property involved, reach out to an expert. I've got down there. Wait, let me see. There, I'm going to point to it. Try to point. I'm going the wrong way. The CDLP. Oh, it's going behind you now. The CDLP is Certified Divorce Lending Professional. I'm part of that organization, the Divorce Lending Association. That's all we do. You know, we geek out on divorce mortgage stuff. So it means that we are uniquely equipped to talk to people and help them plan and help them not make those mistakes. And when they're drafting the marriage settlement agreement, to draft it in such a way that will put them in a position for success, as opposed to putting them in a situation for failure or delay. And as you know, markets move, rates move, all this kind of stuff can change. And as a result, if you're not planning, you get caught flat-footed, it can be disastrous.
And I'll tell you, one of the services I provide, which is so, I think very vital, it's saved a lot of people not having to end up selling the home, is a lot of people will say to me, oh, you know, I just can't wait for this to be over. But, you know, if you look at your marriage settlement agreement, that dissolution agreement, there's a lot of things that sometimes have to happen after the fact. You got to start splitting mortgage, 401ks and assets. And one of the things is you have to meet a timeline when it comes to mortgage and refinancing. And you get this 30-page document, sometimes more, sometimes a little less, but it's in that range. And you don't know how to read it. You know, one of the things I do is I actually create a timeline for clients to say, okay, as of the divorce date, here are the dates that everything has to happen. And one of the big things is going to be the mortgage, because if you are, you've got to start, as Doug said, you can start earlier with the temporary maintenance and build that in to build that 6-month period. But I've had clients that literally closed 2 days after that 6-month period because they were planning ahead of time, as opposed to not understanding some of these things, but drawing that information out of the that MSA, the dissolution agreement, and being able to plan ahead. And sometimes, as we said, you know, the stress, the emotion, taking a 25 to 30 page document you're not familiar with, a lot of people cannot do that on their own. And that's where working with a professional can become so invaluable. Yeah. And I wish I could do more. The one thing I'm going to ask Doug for 1 minute, I love the platform Split Ready. I love what you've done with that. I'm going to ask you to touch on it. We're going to have to get you back, talk a little bit more about the personal side of what you do, how you work with divorcees, and go more into depth on Split Ready. But let's at least cover that for about a minute or so.
You know, my partner and I, Mariah Pleasant is my partner in that. And it's about, it took some of the, you know, you can see the saber behind me, the military thinking that I saw as I started working with divorcing clients was there's really a process to it. And there's a planning process. And that's what we do. We help people with that. We help people think of the things ahead of time. Because as you said, a failure to plan can really, really be disastrous. So it's really getting people prepared for their split. Sometimes they don't even end up splitting up, but it's getting people in the right headspace to do the right thing as they're working through getting a divorce. You know, one of the things that brought me and ahead of me found that is that people looked at the same way they look at their house as a silo in their financial picture. They look at it as a silo in their divorce. And they're like, wait, you know, I'll deal with the house later. I'll refinance or sell it or do whatever. And they're not thinking about it in an integrated approach. And that's kind of what we bring with Split Ready.
Great. No, I appreciate it. You can get a hold of Doug at splitready.com or dkatz at splitready.com. You can also reach him if you want through my website and ask question. I can relay it to Doug at lifecycle.financial. Again, that's lifecycle.financial. Doug, thank you, shedding a lot of insight and light on a ever-changing process. I will say that people who had a mortgage 3 years ago, you're not going to go through the same experience necessarily as you're going through now. So understanding the large financial impact that this can have, and obviously the large commitment that you're making is so, so important. Again, I am Hirsch Sherman, your host for the Financial Wellness Hour. Please do reach out to me through my website at lifecycle.financial. Whether it's for me, for questions for Doug, please reach out. And I look forward to you joining me on the next show. Thank you so much. Be well.
Thank you so much.